So what exactly does a proper, thorough, and detailed portfolio analysis look like, and what components should be involved? We're going to outline exactly what the key factors are when we consider taking a client on as a new investment client, and exactly how to analyze what gaps and what holes there are within their current portfolio. So let's start today. The first one, and probably in the forefront more than it ever has, is fees. You have to make sure that you're paying a competitive fee. If you have $500,000 to $1 million invested and you're paying 2.5% in fees, it's completely ridiculous. With the technology today and the platforms available, you should not be paying more than 1 or 1.25% for the whole process, including the financial planning, portfolio management, tax advisory, etc. So make sure that you analyze and ensure that you're paying a competitive fee and getting all the value-added services included within that portfolio management structure. Second is, you have to understand clearly how you're going to be protected against the next market collapse. It's only inevitable that within every 10 years or so, there's usually one serious, significant market correction. And that often can be as high as 30, 40, 50% or greater. So that is a significant amount of capital to be lost, and there has to be clear, understood strategies so that you know exactly how you're protected. Our clients during the pandemic in March lost less than 2% during a 40% pullback. Why is that? It's because of the way that the portfolio was structured. Not only does it protect capital, it allows you to take full advantage of an eventual market recovery. So make sure that you understand how you're protected. Are you properly diversified? Now, this goes back to risk and protection of capital, but what is true diversification? Owning a whole bucket full of stocks and equities and bonds is not diversification. You have to make sure that you own asset classes that are not correlated to stock markets or bond markets. That includes private equity, private debt, real estate, precious metals, long-term U.S. Treasuries, et cetera, et cetera. There's lots of different asset classes that need to be an integral part of a properly balanced portfolio, not just the traditional 60-40 mandate that we're all accustomed to, 60% equity, 40% bonds. That just simply doesn't cut it in today's low interest rate environment. So making sure that you understand exactly what type of diversification you have. One of the most probably overlooked aspects of portfolio management is the tax implications within the different types of investment accounts. Today we had a new prospect that decided to join our firm that was selling a business, and they're going to have a substantial amount of non-registered savings. But what's unique is they decided to split their nest egg between two different advisors. Understanding how to properly manage tax within a portfolio is crucial to provide long-term income. So for an example, within that non-registered framework, we'll take advantage of return of capital distributions where the tax is deferred completely. We're going to place them inside indexes and ETFs and particular management funds that have a tax deferral mechanism so that you're not paying tax on all the dividends all the way throughout. What that allows you to do is to have less capital withdrawn because you're not having these tax overlays and these tax consequences every single year on the growth of your assets. And within the registered accounts, what are we doing to cap or actually stall or withdraw money out of registered accounts at the most tax efficient manner possible, and make sure that you own the right types of securities in each type of account, not just a blanket portfolio. And last and certainly not least is, what is the clear investment process that your advisory team or your portfolio manager has laid out for how to navigate through a market cycle? So for an example, it does not matter what the cause is of a market collapse or a recessionary period. In fact, it's irrelevant, but the effect is always the same. There are certain assets that perform in a certain manner during that market cycle that are extremely predictable. And we've known this over the last 50 years of investing. And yet we very rarely see a clear protocol and exact process outlined on how to exactly take advantage of these swings in the market. For an example, you should own more private equity and alternatives at certain stages of the market versus owning more equities, more bonds, different types of non-correlated assets like precious metals. All of these different asset classes need to be more concentrated at certain periods and less concentrated. And these aren't decisions that you make just on a daily basis based on an opinion or news. It has to be a process that is clear to follow regardless of what's going on in the news or in the markets. It's all about price movement and asset allocation. So make sure that you have that clearly outlined. And so when we do a portfolio analysis for clients, we'll show them exactly how their performance and their portfolio will look throughout the market cycle in good stock markets and bad stock markets, good bond markets, bad bond markets, and to show them exactly how to exploit those opportunities.